Truett's comment about cost structure, and Mike, industry's changed over the number of years, and we used to look at lot price as a percent. You look at lot price as a percent of revenue. And so back in the day, you might say, well, I'm at, 33% finished lot to revenue. So if I'm, or let's use an easy number like 30%. So if I'm selling a house for $600,000, I can pay 30% for the lot. My finished lot can be $180,000. Okay? There are cost structures that are different. MVR is number one in the marketplace for a number of reasons. They understand their costs down to nail heads, down to pennies. Michael Harris Homes, we're a small builder. We don't have the pricing power in the market with our subcontractors, so our cost structure is a little different. I will tell you that the developer at Crown ran numbers based on finished lot to revenue, saying if the revenue can be X, I should be able to get Y. And they looked at 35%, they looked at 40%, and it's up to the builders who are looking to buy lots to challenge the developer and say, well, listen, the market's only at 650, it's not at 7. You're using this 40% finished lot to revenue number, it's only going to be worth 260, it's not worth 280. And then you get into the negotiation during the Land Act process saying, okay, I'll pay you a base price of $240 for the finished lot, and if I sell houses for over $700,000, because that's where you think the market is, I'll give you some deferred consideration. I'll give you a kicker above my revenue above $700. So I sell it for $710. That $10,000 spread, you give a percentage back to the developer saying, okay, you were right, I can sell houses over $700, and you get them back up to his $260 or his $270 finished lot price. But NVR, who is the bane of our existence here,
anyone here from NVR?
Is anybody here from NVR? I'm not talking out of school. They work on a totally different cost structure than the other nationals in the sub-market or the small cap builders like Michael Harris. And they can, if they want a piece of dirt, they'll stretch their structure to 45% finished lot revenue. Crazy numbers, even approaching 50, because they can build at a better cost structure.
But the concept is the same, and it's simple. Supply and demand. What is a builder willing to pay for these lots? It's that simple. And if the developer was right in his thinking about it's worth 280, he'll know that his profit's going to be X amount of money because he knows what his cost is. If he's wrong, it comes out of profit. Same thing with the builder. We think we could sell a house for $700 at Crown. We think we could pay $280 for the lot. Well, if we guessed wrong on the price and we could only sell it for $650, we're still paying $280. We're still paying all of our costs. It comes out of our profit.
It goes back to what Truett said. If you didn't understand your market and do the research up front, that losing that $50,000 in margin is
you might lose your job.
Is a bottom line. There's a bottom line. So then you're having to backpedal.
Can you talk a little bit about how to avoid the moving target and outside impacts that can impact, where you think you're going to be selling, even with if all your market analysis is spot on, an outside impact comes in and suddenly that target shifts, kind of what aspects of this can be nimble and what can't?
Well, I mean, typically when you do an acquisition, when you're running your financials, you're running your expected strategy, how many you're going to sell per year at a certain price point, and then you might have an exit strategy. What if the market goes to hell in a handbasket, or something impacts, whether it's the financial markets or jobs, the economy, whatever the case may be. What do I need to discount my prices to, and will I discount my prices kind of increase my absorption rate so I can get out of the job faster and burn through it, and maybe I'll still make $1, but I won't lose $1. So I think from a financial standpoint, when we do acquisitions, you're running various scenarios to explain to your division president and to your corporate office, these are the scenarios and this is the what if.
And I think there's also, we'll get down to it further, there's a difference in how you buy, meaning that, you know, if you're paying a finish lot takedowns or projects, sorry, I realize I look down when I talk, so I'm not, nobody's back can hear me. When you buy, you either buy, and we'll get there later, but raw versus finished. If you're buying finished lots on a takedown, there's limited exposure because you do have an out. If the market turns and there's outside influences that will kill a project or kill a segment of the market, you do have the ability to get out. So you typically pay higher prices for those lots, but you pay later in the process and you put a deposit up. And so you kind of know what the worst case scenario if I walk away. On the other side of that is that whole risk reward. If you're doing a value add project where you're actually entitling it and taking it through the process and doing your own self-development, you're paying a lower price for the land itself because you don't have the opportunity once you close to go back to your original seller and tell them that things have changed and I want a discount on the purchase price of the property. So it's very basic risk reward. You know, limited amount of risk is going to result in higher purchase price or higher prices like at Crown or any of these other large scale PUDs or land use developments where you're paying, you know, the finishing is in, you know, the development is actually rolled into the land price. You're paying a higher price, but you're also, you know, your risk is limited. You do have an out, a way to get out, even if it is just a deposit. But if it's a long-term deal where you're buying land, especially if you're buying it unentitled and you're taking the risk of entitlement, then you're taking the risk of development, then you're taking the market risk because most rezoning cases, and we'll talk more about it again, you know, a project like that is 3 years before you get a shovel in the ground in most municipalities. So by the time you contract and take it all the way through, you're not only guessing what the market's going to be next spring or next fall, you're guessing 3 years out. And so that's, you know, kind of gets into how you hedge that way.
Perfect.
Yes?
Absorption patterns, I saw that term used, what is that?
So, again, based on the information that you might receive from a third party, from a Metro Study or a Hanley Wood, or talking to builders in the industry, you will know that Discovery next door, MVR, was sold 30 houses last year. So divide by 12, they're absorbing at 2.5 units per month. So those are the absorption rates. So when you're running your financials, you can say, well, my price point's going to be higher, my price point's lower. I should be able to get 2.5, run it at 3. If I lower my price, if I raise my price, run it at 2 per month. And so those are the absorption rates that you get from neighborhoods.
And price is very important, but absorption
Price and pace. Price and pace.
is almost as important.
And the reason it's important is because any land acquisition is a huge investment, like we talked about. The development's a huge investment. The builder doesn't get paid back until you start settling homes. So you talk about a 200-unit neighborhood where, you know, you've been investing, you know, serious money into millions and millions of dollars, and for the course of 2 or 3 years, you start getting that money back with your margin. Great, you know, you're making money off the project, but if you thought you were going to sell 40 houses a year and you're actually selling 10, the carry cost for the money that you've invested or the return on the equity that you've taken out of your company in order to make that happen is just eating at the project. So we build again, it's further down the agenda, but we build a business model for every neighborhood. So each neighborhood has, you know, an entire, you know, a model that talks about, you know, what you're selling, what you're buying the land for, how long it's going to take you to develop, how much it's going to cost to develop, what your direct costs are going to be. And you put all that together, and that effectively tells you if the job is a good job or not, if it's responsible or not. And you pitch that to the people that you work for. So when you get out into the market, you actually open for sales, if your absorption is way off, in order to get absorption to where you're getting paid back sooner in the project, you're lowering prices. And if you're lowering prices, you're eating margin. So it becomes a question of finding that balance between...
Optimization.
Yeah, exactly. You know, and do I want to make more money on the houses and sell fewer of them? How bad is that hurting me on the carry? Or do I need to get out of the job and we're going to slash and burn and I'm happy just making an overhead play? And the profit's effectively been eaten out because of changes in the market. It is something that our company looks at every quarter. We look at every one of our project plans. Every quarter we go through as a pro forma for each one of our neighborhoods where we update our direct costs, development costs, and all the parts and pieces. And then we start making decisions about, is this project on target? Is it working the way it should work? Do we need to make adjustments? And those adjustments at that point are typically made in our sales office.
Right, there's adjustments, either it could be, it's more incentives, we're not giving away the basement, or 58th anniversary, congratulations for Stanley Martin. So they're giving away 50% of your options right now, which means they're not making any money on their options. Well, they may make some money on their options, but, or you decide you've got a portfolio of houses, and you know the market's moved, and you've got smaller houses that you're building in another location, and you can get those sited in the neighborhood quickly and start rolling out a smaller house with a lower price point. And again, it impacts your margin at the end of the day, but again, you're getting through the neighborhoods.
Hey guys, when do you decide, like, this is probably more for Troy because you develop, when do you decide to bring in other builders on your projects?
It depends. So we've, our company is, our company doesn't buy a lot of finished lots. We do a lot of our own entitlement, we do a lot of our own development. Culturally, that's who we are. A lot of times though, because our projects are sized, to 300, 400 units, we'll bring a second builder and we'll sell finished lots out. And we sell finished lots out, like we were talking about earlier, Mike, to the market, similar to how we would sell houses to the market. We have a couple of different, scenarios that we look at when we're studying a project, and again, out sale of homes actually goes back to the IRR and how long we're going to get through the neighborhood. If I don't think, or we don't think we can sell homes fast enough to get our returns back, but we still want to do the deal, we'll often bring in another builder, because typically, while having another builder in will eat at the number of homes you're selling, hopefully the synergy will drive enough people to the community where you've got two marketing groups that are driving traffic to your neighborhood, and you'll sell lots faster than you would be selling homes, and it all kind of balances out. It's just inputs into the pro forma.
Give you an example, Willowsford, which most of you are probably familiar with, just got purchased not too long ago by NVR. So they bought everything that was left of Willowsford. 900 lots out of 2,000. There's 9 builders in there. A lot of builders are in Willowsford. It used to be just a developer selling to different builders. NVR now has to make a decision. Are they going to build out the rest themselves with different product types so that they could get their money back as quickly as possible and maximize their return? Or are they going to continue to share those lots with builders? They have to make that decision, and they'll do it based on a financial model. If they think that they get a better return doing it all themselves, they'll do it all themselves. If they think they get a better return at the end of the day by doing 3/4 of it or half of it themselves and selling it to other builders, that's what they'll do. Every decision like that is based on a financial model. And it's complex in the calculation, but the idea is fairly simple. It's, if I had that money today, what's the best use of it? If I wait and do it myself, it's going to take me 10 years to get through all these lots, let's say. And I'll get back at the end of the day X dollars. If I sell it to other builders and do it, share it, it might only take 6 years, but I'm not making as much each time because I'm not building the houses. And what's that all add up to in today's dollars? Pretty much that simple. A few other things that come into the calculation, but that's the gist of it. It all revolves around financial modeling and what are the dollars.
Okay, one more.
So would you say the single biggest pitfall for developers and builders in this land acquisition process, development process, is becoming overly dogmatic over time? With approach worked once or several times in one area with one business model, and they kind of processize that and just keep
Well, I think
Don't
that,
reevaluate, don't recalculate, don't give a fresh look.
no, I think that, I mean, in Northern Virginia, Arlington, Fairfax, Alexandria are all infill markets. The idea of large PUDs, having those projects is probably in the past. Willisford is maybe, an outlier. You're dealing with no growth sentiments in Loudoun County. So I think that, I think the approach is, if you find a piece of dirt, you try and figure out how to make it work, and you use as many tools in your toolbox to understand it. So, but I think that builders are thinking out of the box, and they aren't structured in how they look at things, but they're using all the tools they have. So the next few slides are just a few, again, Metro Study is a resource. This is showing traffic and contract report, cancellation rates, conversion rates, how many contracts per subdivision. This is more of a historical trends. The next one really gets into looking at a specific submarket, and I apologize, this was for Maryland, and it really didn't come out real well on the screen, but this was looking at a submarket. I was looking at Poplar Run neighborhood, and this is showing the type of house being built, when it started, what the price range is, what the square footage is, the product that's being built, how many total units they had, what their weekly traffic was, did they convert any contracts, and whether they sold project to date. So this is a resource that kind of gives you an idea on absorption rates and price points as you start to do your value graphs that we'll get into. Again, the next slide, again, is another part of, this is Montgomery County, looking at the Clarksburg submarket. Again, this is third-party work that you pay a fee for, but it's a quick resource because they're sending people out into the field to gain the information. The next one is Hanley Wood. They break the areas down by submarket. We're building in the Maple Lawn area of Howard County. Again, I like the Hanley Wood data better than Metro Study myself. I'm an old school guy, so, but again, breaking down whatever town singles, total plan product, how many they sold, closing prices, gives you an idea. And then MRIS. MRIS information gives you sort of your indirect competitors. There's the resale market, what's going on. Typically there's a premium to be paid for a new home. As we all know, what's that premium? Is it 10%? Is it 15%?
Rule of thumb, and that's kind of part of the guesswork that goes into this. If you're in an area that there's not a lot of new homes, but there's lots of resales, you got to guess that all you have for data is resale information. Well, if those homes are 20 years old, how much more can you get for a similar home that's brand new? And there's kind of rules of thumb that people use. Some will say for every year, it's 1%. So if a home's 20 years old, I could get 20% more for a new home. Some people use 2%. That's a little aggressive maybe, but we have to make those decisions.
And the industry has been kind of static the last decade. So the home features that are in a house that's 10 years old, aren't that dissimilar from the house that's being built today in some respects. When you see volume in family rooms or volume in house, then, we're not doing the volume anymore because we're concerned about energy conservation. The consumer's telling us they're concerned about energy conservation and their cost of utilities and such. But granite's been standard for a long time in kitchens and bathrooms. Stainless steel has been standard for most part in a lot of kitchens. Hardwood in living rooms, dining rooms, kitchens. So a lot of these features that you're seeing in houses maybe 5 to 10 years old. So you have to take that into consideration with the resale market. The next slide is, again, using Hanley Wood. Again, I was breaking down the Maple Lawn submarket. It's looking at all the builders. It's showing me average sales rates. It's showing me that, Mitchell & Best is selling 3 per month, from 700 to 1.1. It's showing me that Envy's got a product selling at 5 per month. And and then the attached product. So this gives me an idea on absorption rates. The next slide is my crude value graph. Brian Stephan's laughing at me, from the back of the room.